Control accounts means that there are some accounts that we are controlling because of their importance or because of the volume in terms of the number that we are going to have at the end of the year. And in this discussion, we are going to discuss about two of them, where one of them is known as the sales ledger control account, and the other one is known as the purchases ledger control account. Those are the two accounts that we are going to focus majorly this particular day. When we talk about the sales ledger control account, this one is also known as the total debtors. It is also known as the total debtors control account. The total debtors control account, whereas the purchases ledger control account is also known as the total creditors. It's also known as the total creditors control account. So at this point, we need to remind ourselves what is a debtor and what is a creditor. From there now, we shall be able to understand what they do and actually how we prepare them. Because once you are able to know how to prepare the debtors accounts, how they are prepared in terms of when the sales occurs, when the payment is made, and all that, then it shall be very, very easy for you to prepare the control account. So if I can start by discussing about the debtors, if I can start by the first one, the sales ledger control account or the total debtors control account, we need to understand who is a debtor. A debtor is simply a credit customer, or a customer who bought goods on credit from the business and that particular person has not cleared his account. So in simple terms, a debtor is a credit customer, and the debtors are normally created. They are created from credit. They are created from credit sales. When we sell goods on credit, that is when we create debtors. So a debtor is going to appear in our business accounts simply because we sold goods on credit to him or her. And what normally happens, when we sell goods to a debtor, we normally come here and open the debtor's account. Maybe the customer is by the name Jane. We shall have the debit and the credit. And then the debtor, because he has our money as the business, we normally debit this particular account. We normally write the date here, we record here sales, and maybe Jane bought goods of 2,500, so we are going to debit Jane by 2,500 like that. On another day, we can have another debtor. Maybe the debtor is by the name Water. We can have another debtor by the name John, who has bought goods worth 900. We shall come here and debit John by sales 900. If we have another debtor, maybe by the name Joseph, we can come here and open the Joseph account and debit Joseph by sales of maybe 1,200. So you realize that whenever we sell goods on credit to a customer, then the customer who is our debtor will always be debited. The customer will always be debited, and the customer will be debited by sales because we have sold the goods to him or to her. And then we shall go and credit the sales account the normal way we normally do it. But our focus is not on the other account. Our focus is only on the debtors account, because the debtors accounts are the ones that we normally use to prepare the sales ledger control account. So at this point, I want you to understand, anytime we sell goods to a customer on credit, the customer becomes a debtor, and that particular customer will always be debited by the value of goods he or she has acquired on credit terms. So that is at the point of sale. Then you realize that because we have sold these goods to these particular debtors, it will reach a time when these people are going to pay. It will reach a time when they are going to pay, Either they are going to pay in full or they are going to pay in installments. If, for example, it reaches a point whereby Jane is paying and maybe she's able to pay 500 first, you will find that because the account was debited and now she's paying back, we are going to credit the account because paying the debt simply means that this particular debt is reducing, the 2500 is reducing. And in accounting, as we always say, if an account is reducing, we normally record it on the opposite side. We cannot debit again and the person is paying. When we debit, we simply means that the debt is increasing or the person is acquiring more goods on credit terms, which is not the case. So what is going to be the best practice? Because the person is reducing the debt that he has to the business, you will come here and record it on the credit side. You will come here and you say either cash or bank, depending on the mode of payment the person has used. If he has paid by cash, you credit this account by cash and you write 500. If the person has written you a check of 500, you will credit by bank 500. So this one will now look like it is 2500 minus 500. So the person has got a balance of 2000. The balance has got a 2000 balance. So remember that in accounting, if the figure was debited and now the account is being reduced because of the payment, you record it on the opposite side. If we put it here, it simply means that the person now has a debt of 3,000 instead of 25. So debiting means that the debt is increasing. Crediting means that the debt is decreasing or is being subtracted like that. So when Joseph would pay, maybe Joseph has decided to pay the entire amount, you'll come here, maybe he has written a check, you'll come here and credit by 1200. You credit by 1200 because it is this now minus that. The person has no balance. It has a nil balance. If it is then who has decided to pay 800, you will come here and maybe say cash 800 like that. So the person will have 900 minus 800. The person will have a balance of 100 like that. Sometimes also these customers might return goods back to the business. Those goods that are returned back to the business are known as the sales returns. We can experience what we call the sales returns. We can experience what we call the sales returns, also known as return inwards. Goods sold to customers. At one point, you might find that the customer has decided to return part of those goods back to the business. And those goods which have been returned back to the business are the ones we are saying they are also known as sales returns or return inwards. So those two terms, they mean the same thing. Whenever a customer has returned goods back to the business, the person is reducing what he or she was to pay the business. Like, for example, if we sold the goods to Jane of 2500, he paid 500, and then at a later time, he realized that part of these goods that we sold to him of 2500, part of them, maybe they were not of the correct size. Maybe they were undersized or they were oversized and things like that. They were not of the quality that he had ordered and all that. What the customer will do, he or she will return those goods back to the business. And remember, we are talking from the point whereby the business is ours. We are the ones who are preparing these accounts. So if the customer returns goods back to your business, you are going to reduce the amount he's supposed to pay, because a customer cannot pay for the goods he has returned back to you. So maybe the person has returned goods of 1,000. So you come here and credit this with return outwards of 1,000, so that now the debt is still reducing. It has now reduced by 1,500. The balance is actually 1,000. So you will find that at another point whereby maybe the customer has been given discount. You have allowed your customer a discount, and that is actually what we call the discount allowed. If this particular person, you had an agreement with her that if you pay within 1 week, I'm going to pay you a discount of, I'm going to give you maybe a discount of 100 shillings. I'm going to give you a discount of 100 shillings, and the person actually pays within that 1 week. So what will happen? You are going to give that particular discount to the customer as per the terms of sale that you had agreed, that you are going to give a discount to that particular person. So that is what we call the discount allowed. Discount allowed will also reduce the debtor's balance, so it is going to be credited. We are going to write here discount allowed of 100, like that. So at this point, what I want you to get, and you get it clearly, is this: when it is about debtors, whenever they are increasing their debt, we normally debit their account. Whenever they are reducing their debt, we normally credit their account, and things like that. At some point, you might find that this 100 shillings that we were demanding to be paid by John as the balance here, maybe John has been declared bankrupt, or John has unfortunately passed on, and the person is no more. You cannot keep on waiting for this particular 100 to be paid, and the person is no more. What you will do, you are going to come here and declare that particular debt from the customer as bad debt. You are going to come here and declare that particular debt as bad debt, and you put here 100, so that this account will not have any balance for you to keep on waiting. And this bad debt in final accounts is going to be considered as an expense to the business, because it is money lost. So you find that is going to be on this side, and the other things that might happen. So you realize that anything that is actually reducing the debtor's balance, it is credited. It is credited like that. And anything that is actually increasing the debtor's balance is going to be debited. What we normally debit to the accounts of the debtors also includes the things like the dishonored checker, the dishonored check. You might find that this check that we received from Joseph of 1200, the check, when we took it to the bank did not accept it. The bank maybe realized that the balance in Joseph's account was only 600, and therefore there was not enough money in his account to clear this, so the check will be returned back. So if the check has been returned back, which had already been recorded as received, that particular check is normally taken to the other side, and then it's like reversing the entry. Yeah? So remember, it was 1200 minus 1200. The person had no balance. But upon taking the check to the bank has rejected the check, which simply means that this person has not paid you. This person has not paid you, because the check that he used to pay you has been actually declared dishonored by the bank. Then the person has not paid you. You normally return that check or that amount to the debit side of that particular person as 1200, meaning that the person has received the debt of 1200. So basically, those are the entries that are going to be involved. And lastly, for your understanding, we also have some interest and penalties. The interest and penalties that we can charge our customers for delaying their payments. We can have an agreement that you maybe karaoke. I'm going to give you goods of 5,000, and you are going to pay me within a month. If you don't pay me within that 1 month, I will start charging an interest of 5% for each and every day you are going to delay the payment. So you find that once now we have got that agreement and the customer has delayed paying his account as per the sales agreement, and you start charging interest or penalty on the delayed amount, then the debt will start increasing. If it was 2,500, you charge 10%, it becomes 25 each and every day. It will be increasing by 25. By the fact that it is increasing the amount that was supposed to be received from the customer, then it is going to be debited. It is going to be debited. So we normally debit anything that is increasing the debtor's balance, including the discount, the dishonored check, the credit sales, the the penalty, and lastly, another item that is going to be debited is known as the refund to customers. We have got an entry we call refund to customers. Refund to customers. Sometimes the debtors can pay you extra amount. But before I give an explanation to that, allow me to go back a bit and remind you where we are coming from. The control accounts, they are meant to control the entire group of accounts. The entire group of accounts. So in the sales ledger control account, we are going to have one ledger account, one T account that is going to give us a summary of all the debtors that we interacted with as a business in a particular time period. All of them. If there were 50, all of them, we put them in summary in one account, and that summary account is what we call the control account. Like, for example, if we sold the goods to Jane 2,500, we sold the goods to Joseph 1,200, and we sold the goods on credit to John 900. Instead of having this one separately recorded, we can come and have one account, and then we record sales. This plus this is 37, 37 plus this one is 48. We can simply have one account, and then we come here and we debit and we say sales 4,800. Instead of having individual ledger accounts, we have all of them combined in one account. If it is sales, we add all the sales. If it was all the checks that were received, maybe it was a check of this and a check of this, those are the checks of 1,500. We come here and 1,700, sorry, we write bank 1,500. Instead of having an individual account, we condense them into one account, and that one account that is having a summary of all the debtors, that particular account is going to be known as the sales ledger control account, or sometimes known as total debtors control account. And total debtors nowadays, they are also known as the accounts receivable. Therefore, the account can also be known as the total receivables control account. So it is one account that is giving a summary of all the individual ledger accounts of the debtors. So if it is sales, we add all of them. If it is cash received, we add the cash that we received from John, cash that we received from Jane, cash that we received from Joseph. We come here and we put cash received. Maybe it was 2,100. If, for example, it is goods that were returned, you add the goods that were returned by Jane, goods that were returned by Joseph, goods that were returned by John. Because all of them are supposed to appear on the credit side, you come here and you put them as return inwards. Maybe they were worth 1,900, all of them. So you put a summary of individual ledger accounts in one account. That account is what we refer as the sales ledger or the debtors control account. Allow me now to talk about this entry I'm talking about, which is refund to customers. Refund to customers. Refund to customers. Refund to customers will occur when actually some of the customers have overpaid the account. Some of the customers have overpaid the account, and then they realize that they have actually overpaid, and therefore they are seeking for a refund. So at the back of your mind, I want you to understand that the control account is actually a summary of all the accounts. You might find that if I'm the owner of the business, I might have my record where I'm saying that the total amount of money that I'm supposed to receive from the debtors in a particular period, maybe the total amount is amounting to 15,000. If I add what I'm supposed to receive from this person, all of them combined, they are supposed to have a total of 15,000. That is actually what I expect to receive. Then a customer out of this balance pays 5,000. One of the customers pays 5,000. What you have to do as the owner of the business, if you are expecting this and this one has been paid, then you expect now 10,000. Now the balance is 10,000. as far as you are concerned. But what if the customer who pays 5,000 has overpaid? The customer who had paid 5,000 has actually overpaid, or he has paid excess by 500. So the correct amount was supposed to be 4,500. So it simply means what you have received here is 45 because actually you have refunded the 500 extra. What you have received here is 4,500 and not 5,000. And therefore, what you expect to receive from the others cannot be 10,000. Now it will be 10,500. You had received 5,000, so the balance was 10,000. Now that the person has claimed a refund and actually genuinely it is a true refund, you refund 500, then the person has actually paid you 45. If you are expecting now 10, but now you are given a refund, it simply means that there is somebody who is supposed to pay that 500 that you had initially deducted. So you push back the figure to 10,500. So that refund is going to make the total amount of money that you expect from the debtors to go up. And that's why the refund is going to appear on the debit side of the control account. So I would prefer to give you now a summary of how the sales ledger control account is going to look like. The sales ledger So it is a simple T account with the debit side and the credit side like that. The debit side, as I've said, it is going to record those items that increase the debtor's balance. The balance that you expect from your debtors, those items that are going to push it upwards, they are going to be debited. And these are the credit sales. You put the figure given there. Dishonored check. Dishonored checks, it is going to appear there. We have refund to customers or debtors. Customers are the same as the debtors. You put the amount refunded there. And then we have got interest or penalty charged on debtors. Those are going to be debited. And not forgetting, always we shall be starting with balance brought down. Balance brought down will always appear at the top. And then on this side, sometimes we can also have a balance brought down also. This one is a must. The debit balance is a must, but this one, it might be there or it might not be there. But if it is there, it is always going to be less than this. It is always going to be less than this. And what it means that, remember the balance on the debit is what we expect the debtors to pay us at the beginning of the period. So it is a balance that we have brought forward from the previous period. What the debtors did not pay the last period, we bring it forward to this particular period, or we start with it, and then we include now the entries for the year. So the balance that is going to be on the credit side is actually the amount of money we are supposed to pay the customers. Either they have not been refunded and they have paid, either they had paid already and then after paying and clearing the account, then they return some goods. So whenever they have returned the goods and they had already paid the business, so it is the business now that owes the customers and things like that. So such cases will have a credit balance there. Then on the credit side, now we record the cash received from the customers because it is reducing, it is credited. Checks received from the customers, you credit. We are going to consider also the bad debts written off. We are going to credit that. You are going to have the discount allowed. It is also going to reduce. We also have return inwards. It is going to reduce the amount that we are going to receive from the debtors. And then we have got what we call the contra, or what we normally also refer as the set-off. It is also going to reduce. And then at the end of the year, you are going to calculate the balance, carry it down, you put it there. And then your account will have balance, and then it is the end of the day. Sometimes the balance carried down might also appear on two sides, like that. That is your sales ledger control account, or the total debtors control account. It is going to appear like this. These four items, the credit sales, the dishonored check, refund, and the interest or penalty to customers. Remember, it must be credit sales to customers, dishonored checks from customers, refund to customers, interest or penalty charged on customers' overdue accounts. They must be related to customers, because you can find a dishonored check, but it is a dishonored check that was issued to suppliers. You only take what was from the customers, because the sales ledger control account, it controls the debtors who are actually customers. The other thing to note, and note keenly, is that in this control account, we only consider the credit sales. We never consider the cash sales. We never consider the cash sales, because cash sales will never result into debtors. Whenever goods have been sold in cash, we have not created a debtor there. A debtor is only created when goods have been sold to him or her on credit. So cash sales will never appear here. And if you are given the cash sales in the question, that is in an exam, just ignore the figure. That figure is just a distractor. That figure is just a distractor. It should never be recorded here, because cash sales do not create debtors. Debtors or receivables are only created when goods are sold on credit to them. And actually, they are those people who have got your money. And if goods have been sold on cash, that person does not have your money. All that should be taken into full consideration. So that is all about the sales ledger control account. Remember, the items that are on the credit side, they are the entries that are going to reduce what the debtors are supposed to pay you. Either they are reducing by paying you by cash, by paying you by checks. Some of them have been declared bad debts. Others have been given the discount, the return inwards, and the contra. Allow me to explain the contra, because I know that one is a new term to you. A contra or set-off is going to arise whereby a business is relating with another business in a manner that I am the customer to that business, and they are also my customers. What I mean by that is that two businesses are behaving such that they normally sell and buy goods from each other. I sell goods to A, and A sells goods to me. Therefore, we are both customers, and we are also both what? Suppliers. We are both customers, and we are both suppliers to each other. What if now I sold goods to A worth 1,000, and A also sold goods to me worth 1,000? In such kind of a relationship, then it simply means that there is no debt. Nobody owes another one debt. And that is actually what we call a set-off or a contract. It is a transaction whereby I owe somebody money, and the person owes me a certain amount of money. So the money that I owe the person and the money that I owe, he owes me, that is, they cancel out. They cancel out. That is what we call a set-off. If I owe you 500 and you owe me 500, then there is nobody with another person debt. That debt has been cancelled. Also, you can have a case whereby I owe you 1,000, you owe me 500. It simply means that the 500 has cancelled, so I only need to top up the 500 because I had more debt than what you had to me. So the one that cancels, the one that cancels is what we call a set-off. So out of the figure that you are expected to receive from the customers who are debtors, there is a figure that has cancelled with the debt that you had to that particular customer. That figure is going to reduce the amount that you are going to receive, and actually is going to be taken here. And the funny thing about the set-off, it is going to appear in both the sales ledger control account and the other control account we are going to discuss, known as the total debtors control account. The total debtors control account. So that is very important for you to be able to understand as far as the control account for the sales ledger is concerned. Having said that, I would want us now to consider the next and the last ledger control account, that is the purchases ledger control account. Purchases ledger control account. This one, it controls what we call the creditors, who are also known as the payables. The creditors are also referred as the credit suppliers. Credit suppliers to the business. These are the credit suppliers to the business. People from whom we acquired goods or stock on credit terms. They are actually known as the creditors or the payables. What you need to understand here is that whenever we purchase goods on credit from a supplier, we normally come here and open the account for that particular supplier. Maybe it is James, and we credit the account. Remember, creditors are normally credited, and creditors, they arise as a result of credit purchases, as a result of credit purchases. So we come here and we credit, and we shall write the name purchases here, and we write here maybe we have purchased goods of 15,000 from James. Maybe on another date, we purchase goods from another supplier, Maria, and then we come here. We shall credit the account for Maria by purchases. Purchases, maybe it is 8,500. On another day, we buy goods from Fatuma suppliers. We come here and we credit Fatuma by purchases. Maybe 7,200. So you realize that anytime we buy goods on credit, we normally credit the suppliers. And these suppliers are the people now we call the creditors. Creditors are going to be credited. And these are people we owe them. We owe them money because we purchased actually inventory or stock from them on credit terms. So they are always going to be credited. A credit in a particular account of a person, that simply means that it is the business to pay the person. But when it was a debit, it is actually the customer to pay the business. So that's why we normally say that liabilities are normally credited. Liabilities are normally credited. So this is a liability to James because the business needs to pay the supplier by the name James. So we also have Maria, who is another supplier. We credit Maria because actually we owe Maria a certain amount. So when we credit the accounts, these accounts are actually debts the business is supposed to pay on the due date. And then when we pay them, because we are the ones to pay, we are going to debit them. We are going to debit them. Maybe we have paid this one by check. We come here, we write bank. Maybe it is 2,500 we have paid. This one we have paid by cash, 3,000. This one we have paid in maybe also by cash. And we have cleared, maybe we write here 7,000. We have paid 7,000. And then maybe we had an agreement with the Fatuma. If we pay within 1 week, the person is going to give us a discount of 200. So if we pay within those 2 weeks, he was to give us the discount of 200, and therefore, and we paid within that particular time frame, so we enjoyed a discount of 200. that discount is going to be discount received. That is going to be a discount received of 200, so that now this account is not going to have any balance of debt. Because we paid 700 and we enjoyed a discount of 200, that account has been cleared like that. And other things, maybe on this particular person, Maria, yes, we bought goods of 85, we have paid 3,000, but we have returned some goods, what we call return outwards, maybe of 1,800. We have returned goods to him or to her of 1,800 like that. Then it is going to be on this side because it is reducing the debt. So you realize that this is more like the opposite of the debtors control account. Whereas when the debtors are increasing, we normally debit them. This one, when they are increasing, they are normally credited because liabilities are credited. That is the basic underlying principle. But when the liabilities are decreasing, we normally record them on the debit side. So you'll find that in this particular account, whatever we were debiting, or the similar entries that we were debiting in the debtors control account, those entries are now going to be recorded on the credit side. And those entries are the credit purchases is going to be credited. Instead of credit sales, now here it must be credit purchases. It will be credited. The dishonored check issued to suppliers, it is going to be credited in the creditors control account. The penalty charged by suppliers to us, if we delay paying and then they charge us penalty, it is going to increase the amount of money that we are going to be paying them. So it is going to be credited. So any credit entry in this particular accounts, it is going to be on the credit side. Anything that is going to reduce what we owe the suppliers, it is going to be debited actually. So that is in a nutshell. Then you remember the same concept applies. Instead of having so many suppliers account differently maintained, we can actually come and condense them and put them in one account. And that one account that is giving us a summary of all the creditors, that one account is going to be known as the creditors control account, commonly known as the purchases control account or total purchases control account. The same note applies when we buy goods on cash basis. We have not created a liability, so it is not going to be recorded. All the cash purchases will never be recorded in the purchases ledger control account because there is no liability created. Okay, just a minute, just a minute. So, in summary, let us have a format of that particular account. The purchases ledger control account format. We have said those entries that are going to increase the creditor's balance are going to be credited. So on the credit side, you are going to have the credit purchases, we are going to have the dishonored checks, issued to suppliers, we are also going to have the interest or penalty charged by suppliers. Then we are going also to have refund from suppliers. So those are going to be credited because they are increasing the liabilities, because they are increasing the liabilities. Then those which are going to reduce, discount received, cash paid to suppliers, checks paid to suppliers. We also have return outwards. We also have contra or setup. So the contra is the same figure that we had credited on the debtors control account, the same figure we put here. So a contra arises whereby a business is a debtor and a creditor at a particular point. We are a debtor because, actually we are a debtor because we are supposed to pay somebody. We are actually debtor because we are supposed to receive money from somewhere, and then we are a creditor because we are paying someone a certain amount of money. So because of that aspect, we are debtor and creditor, and these accounts are meant to control them. Then we need to have it on both sides. It is reducing what we are supposed to pay, and it's also reducing what we are supposed to receive. What we are supposed to receive is from the debtors, so it is reducing, it is credited, and it's also reducing what we are supposed to pay somebody, so it is going to be debited on this particular account. So those are the simple control accounts that we have. Then allow me to take you through the notes that you have briefly before we meet in our next lesson. So I want us in our next lesson, we just go into examples. So I will take you through these notes briefly. The control accounts, they are actually accounts that summarizes and combines all the subsidiary accounts of specific type. I think that one has said, instead of having separate accounts for each and every debtor, you can have them summarized in one ledger account, and that one ledger account is going to be called a control account. And then we have got two main types of control accounts, the sales ledger control account and the purchases ledger control account. For the sales ledger control account, it is also known as the total debtors control account. And then the balance in this ledger account should be the same as the balance of all the individual ledger accounts of the debtors. So if, for example, John had a balance of 1,000, we had the other one was Joseph, maybe had a balance of 500, and maybe the other one had a balance of 500. This 1,500, 500, when we prepare our sales ledger control account, our balance should be the same as the 2,000. 2,000 is derived from 1,000 of John, 500 from Joseph, and maybe 500 from Jane. The three of them combined, they are giving us a balance of that figure. So the balance we get here is the same as the balance of all the ledger accounts combined. Then we have the debit entries, which increase the debtor's balance, and the credit entries, which decrease the balance, as I've actually said. For the debtors, debit anything that increases the debtor's amount, credit what is decreasing the debtor's amount. Then we shall have the items that increase the debtor's balance. We have the credit sales, the dishonored checks, the interest charged on overdue accounts, and the refund to credit customer. So these are the only four items that you can find on the debit side of the sales ledger control account. These four. But remember, they must be related, because if it is a dishonored check and it is written dishonored check from or issued to supplier, it cannot be recorded here because it does not actually belong to the debtors and things like that. Then the items that decrease the debtor's balance, we have got cash or bank payments from debtors or received from debtors, return inwards, discount allowed, the contra or set off, bad debts written off, among other things. They are all credited. They are all credited. We have the balances. Actually, this format, we have done them on the board. The purchases control account, it is actually an account that summarizes all the creditors' ledger accounts, and the debit entries are those that reduce creditors' balance, and the credit entries are those that increase the creditors' balance. Those that increase are going to be credit purchases, dishonored check, interest charge on overdue account, and refund to credit suppliers. Then whatever that is going to be debited, cash or bank that is paid to creditors, return outwards, discount received in a contra or the set-off. Those are going to be debited, among others. We have the format, and that is the end of that. So when we meet in our lesson at 11, at 11:15, in that particular lesson, we are now going to discuss on how do we prepare them by looking at the examples.